Good day, everyone. My name is Loreto Atamosa, and welcome to Lesson 4, the last lesson of this module. In this lesson, you will enjoy learning about the types of control strategy and techniques, management control system, accounting methods, and incentives program. So the control systems are tools to aid management for steering an organization towards its strategic objectives and competitive advantage. Management controls are only one of the tools which managers use implementing desired strategies. However, strategies get implemented through management controls, organizational structure, human resources, management, and culture. And at the end of our video discussion, all of you guys are expected to distinguish control methods and system, including to explore the traditional techniques of controlling. And so, let's go! So first, let's define control. So control is a process that directs the activities of individuals towards the achievement of organizational goals. It is how effective managers make certain that activities are completed as planned. It does not only mean reacting to events after they happen. It also means continuing an organization on road and anticipating events they may take place. Controlling, on the other hand, is the process whereby managers monitor and regulate how efficiently and effectively the organization and its members are carrying out the activities essential to accomplish organizational goals. So, control operates in three modes in relation to time: feed-forward, concurrent, and feedback. First, let's discuss feed-forward control. Feed-forward control focuses on the regulations of inputs, including human, material, and financial resources that flow into the organization. That is to make certain that they meet up with the standards. So feed-forward controls involve identifying and preventing problems in an organization before they occur. So feed-forward controls are proactive and preventive. Feed-forward controls are helpful to managers because they allow a manager to plan work effectively. So they can regulate resources like employees, raw materials, and capital ahead of time. So this means that future problems can be avoided. Although feed-forward controls can be costly and can slow down the planning process, they help to avoid problems later on. And second, we have concurrent control. So concurrent takes place while an activity is in progress. It involves the regulation of ongoing activities that are part of transformation process to ensure that they conform to organizational standards. So concurrent control is designed to ensure that employees' work activities produce the correct results. So concurrent controls involve identifying and preventing problems in an organization as they occur. This means that systems are monitored in real time. Therefore, concurrent controls begin with standards and all employee activity is measured against the standard. Usually, these include quality control standards. This means that products and services can be checked as they are being produced or performed to be sure that the highest quality product or service is being produced or provided. And lastly, feedback control. So this type of control focuses on the outputs of the organization after transformation is complete. Sometimes called post-action or output control, fulfills a number of important functions. For one thing, is often used when feed-forward and concurrent controls are not feasible available. Feedback involves identifying and correcting problems in an organization after they occur. So feedback is used when the previous controls, feed-forward and concurrent, would cost too much or take too much time. So some organizational goals simply cannot have a preventive measure and cannot be measured in real time. And so let's proceed with control strategies and techniques. So according to William Oakey, there are three broad strategies that could be utilized to accomplish control in the organization. And these are the following. First, we have the bureaucratic control. It is the top-down control in which managers try to use influence employee behavior by rewarding or punishing employees for compliance or non-compliance. It makes use of rules, regulations, and formal authority in order to guide performance appraisal to regulate behavior and outcomes. Therefore, bureaucratic control requires developing of comprehensive system of rules and procedures to manage the actions and behavior of people in the organization. So it often requires costly information systems and computer software to work effectively. Second, we have market control. So this is based on the use of pricing mechanisms to control activities in the organization as thought they were economic transactions. Business are treated as profit centers and trade resources with one another through these mechanisms. So the assessment of managers managing these profit centers is made using the basis of profits and loss. Lastly, we have plan control. So this is based on the idea that employees may share the values, expectation, and goals of the organization and take action based on them. So plan control refers to the values and beliefs of an organization that operates more like a family than a company. So in plan control, high-level management is seen as mentors rather than bosses. So there are very few rules and policies put in place by organizations because it relies mostly on the trust of its employees. So the company will have a strong focus on teamwork and a consensus of its employees. And so let's proceed to the 10 traditional techniques of controlling being used by managers in controlling, namely direct supervision and observation. So direct supervision and observation are the oldest techniques of controlling. So the supervisor himself watches the employees and their work. This brings him in direct contact with the workers. So there's so many problems are solved during supervision. Second, we have financial statements. All business organizations prepare profit and loss account. It gives a summary of the income and expense for a specified period. So they also prepare balance sheet, which shows the financial position of the organization at the end of the specified period. Therefore, the financial statements guide the management for effective use of capital employed and determine the level of credit obtained from the banks and financial institutions. So the well-drawn and properly constructed financial statements helps for effective policy formulation. And third, we have budgetary control. A budget is a planning and controlling device. So budgetary control is a technique of managerial control. Through budgets, it is the essence of financial control. Therefore, budgetary control refers to how well managers utilize budgets to monitor and control cost and operation in a given accounting period. In other words, budgetary control is a process for managers to set financial and performance goals with budgets, compare the actual results, and adjust performance as it needed. Fourth, we have break-even control. So break-even analysis or break-even point is the point of no profit, no loss. So another form of financial analysis is break-even analysis. It is a technique for finding a point at which a project will cover its cost or break even. It is often used to make an initial decision on whether to proceed with the project. So break-even analysis is also a technique of financial control in the sense that further analysis may be necessary as conditions change. Fifth, we have return on investment. So investment consists of fixed assets and working capital used in business. So profit on the investment is reward for risk-taking. So if the return of investment is high, then the financial performance of a business is good and vice versa. Therefore, return on investment is calculated by dividing the profit earned in an investment by the cost of that investment. And sixth, we have management by objectives. So management by objectives facilitates planning and control. It must fulfill the following requirements. We have objectives for individuals are jointly fixed by superior and the planning subordinates. Second, we have periodic evaluation and regular feedback to evaluate individual performance. And lastly, achievement of objectives bring rewards to individual. The 7 traditional techniques of controlling, we have management audit. So management audit is an evaluation of the management as a whole. So it critically examines the full management process like planning, organizing, directing, and controlling. So it finds out the efficiency of the management. 8, we have management information system. So in order to control the organization properly, the management needs accurate information. So they need information about the internal working of the organization and also about external environment. So a management information system is an information system used for decision making and for the coordination, control, analysis, and visualization of information in an organization. So the study of the management information system involves people, processes, and technology in an organizational context. And ninth, we have PERT and CPM techniques. Program evaluation and review techniques were developed in USA in the late 50s. Any program consists of various activities and sub-activities, so successful completion of any activities depend upon doing the work in a given sequence and in a given time. So basically, CPM or Critical Path Method and PERT or the Program Evaluation Review Technique are project management techniques, which had been created out of the need of Western industrial and military establishment to plan, schedule, and control complex projects. And lastly, we have self-control. Self-control means self-directed control. So a person is given freedom to set his own targets, evaluate his own performance, and take corrective measures as and when required. So self-control is especially required for top-level managers because they do not like external control. Self-control is the ability to control oneself in terms of having mastery over one's desires and appetites. So those who are self-controlled can temper what they want. That is to ensure that they do not over or underindulge. And now let's proceed to management control system. So a management control system is a system which gathers and uses information to evaluate the performance of different organizational resources like human, physical, financial, and also the organization as a whole in light of the organizational strategies pursued. So according to Simons in 1995, management control systems are the formal information-based routines and procedures managers use to maintain or alter patterns in organizational activities. And according to Anthony and Young in 1999, showed management control system as a black box. The term black box is used to describe an operation whose exact nature cannot be observed. So broadly speaking, management control systems are methods that business use to collect information that will later give and direct behavior of corporate officers and managers, usually in order to achieve some specific goal. So many of these are focused on either financial or managerial accounting. Some of the most popular control systems are focused on either financial or managerial accounting, which is to say money that is spent by the company as a whole as compared to money that is spent by separate division or individual managers. Now let's proceed to accounting methods. So some of the most commonly adopted systems involve accounting. Actually, controlling the spending activities within a company is a complex endeavor in most cases, and as such area is often broken down into the related sections of financial and managerial accounting. So financial accounting generally focuses on internal issues such as reporting sales or cost. Therefore, financial accounting is a specific branch of accounting involving a process of recording, summarizing, and reporting the myriad of transactions resulting from business operations over a period of time, while managerial accounting may focus on broader things like determining products' costs. So managerial accounting is the practice of analyzing and communicating financial data to managers who use the information to make business decisions. Now let's proceed to incentive programs. Many of the most direct employee benefits and incentives are financial, often in the form of raises and salary bonuses. But not all are. So control system can help make more efficient these non-monetary structures too. So directors often are in charge for coordinating activities with human resources to generate employee incentives for work well done and higher upper level managers. And lastly, we have performance evaluation and employee monitoring. So complete and accurate performance evaluations may be one of the most important methods in determining an employee's strength and retaining the most competitive and efficient employees. So management control system allow for flexibility and outside factors to affect the evaluation process. For example, if external explanatory circumstances negatively affect sales or productivity, an evaluation may account for his factor and include it as a part of the evaluation process. Alrighty, so you guys have an outstanding performance. You just have finished the ABM3 module. So I firmly believe that you are now ready to take a lead and practice all of the lessons we've been discussed. So thank you for your effort, patience, and cooperation all throughout the lessons, which intended to provide new sets of learning that is useful to build and enhance your entrepreneurial career. My name is Loreto Tamosa. Stay safe and healthy. Goodbye!